Hey, it's Seth, your mortgage strategist, helping you get more deals to the finish line. Happy late 4th of July. Hope you had a weekend of celebration. There has been a ton going on in the markets over the last few days, so wanted to give you a quick version of what actually matters for you and your clients. You see, oil prices have continued to move lower as things are starting to settle in the Middle East. They're now trading at below $70 a barrel. And that matters because lower energy prices can eventually help inflation continue to cool. The catch is this, that the gas prices tend to go up quickly when those oil prices rise and come back down much slower in the process. So it does take a little bit of time for that to show up in those inflation reports as gas prices also come down. On the employment side, we're starting to see that there are some signs of weakness within the market. The latest jobs report came in softer than expected. Previous months were revised even lower. They overestimated some of those numbers. And so now we're seeing a significant number of job losses. However, the unemployment rate this week actually showed that it was going down slightly, not necessarily for a good reason. A large number of people actually left the labor force who are no longer working, which can actually make that unemployment rate look better, even when the underlying job market is definitely weakening. At the same time, the Fed Reserve is definitely sending some mixed messages. Some of the Fed officials continue to sound concern about inflation. They've been talking about keeping rates higher for longer, potentially even increasing those rates, while other data is actually pointing to a slowing economy like we just saw with lower jobs and inflation coming down. So what does this all mean for mortgage rates? Honestly, we're in a choppy market still in the interim. One report can help move bonds and rates higher, vice versa. One comment from the Fed or official or a new report can definitely move them in the other direction. However, there is some long-term reasons for optimism. If inflation in the labor market continue to soften, I would expect that these long-term interest rates might continue to come down. But I would definitely not build a home buying plan around rates dropping in the next week or two, or even in the next month. But as we know, clients who are looking for a house based on the daily market rates is actually a terrible approach. Let's come up with a strategy that's conservative on interest rates based on their budget and not determined by the ups and downs of the daily market. That way you and your clients can go shop with confidence, know their numbers, and they can move on the right house when the right opportunity shows up. Look forward to chatting with you soon.